Hello, Real Vision. This is Sebastian Moonjava, and today we have Benjamin Cowen, who does the Into the Cryptoverse. He has a newsletter and he runs a YouTube channel that I am a big fan of. So I'm really happy to have him on. Ben, how you doing?
Doing great. I'm happy to be here. Thanks for having me on.
Yeah, absolutely. Let's start with a little bit of your background. We were just talking off air how you just made this transition to doing this stuff full time. Tell me a little bit about yourself, your background, and how you got into crypto.
Yeah, so my background is I did my undergraduate degree in math, and it was during I think it was during like 2011, late 2011. I was taking a cryptography class, and at that point, I actually learned about Bitcoin. Unfortunately, I did not invest in Bitcoin at the time because I was a poor college student. But that was when I first learned about it, and then I went to grad school, did a PhD in nuclear engineering, and was following the crypto markets fairly avidly during that time period. And after I graduated, I launched my own content that I wanted to kind of present to the world, like, hey, look at crypto from this other point of view. And been doing that ever since. So since 2019, we launched the YouTube channel, and it's grown a lot since then.
That's exciting. And so what do you consider, like I said, I've been a fan of your channel. I watch it. It's pretty awesome. You are, you focus on data, but you're not necessarily focused on like on-chain data. Can you talk a little bit about how you consider what you do?
Yeah, so as far as on-chain data, I think we do maybe a few videos on it here and there. Sometimes we'll look at, like transaction fees or daily transactions, active wallets. But we mainly look at I sort of approach things from more data science perspective based on price data. So I wouldn't call it fundamental analysis as much. One could say it's closer to technical analysis, but it's also, there are some differences between, I would say, traditional technical analysis that a lot of people might do and what I tend to do on my own stuff. At the end of the day, I would say it's more akin to data science. But it's very closely related to technical analysis, but it's probably going to be slightly different than what you might see elsewhere.
Yeah. And so we were also talking about how a lot of what you're going to be presenting here is sort of like modern portfolio theory. And you had talked about potentially some of the, downsides to that. Can you maybe explain a little bit about what modern portfolio theory is? And yeah.
Right. So modern portfolio theory has been around for a long time, and people use it to try to construct portfolios that meet their risk-adjusted returns. Like if they have a certain goal of what return they would like to see, you can actually put together you can run a Monte Carlo simulation on, say, 1 million different portfolios and figure out, based on, say, historical returns and historical volatility, what would be the portfolio weights that would maximize your risk-adjusted returns. So like on this chart, this is a combination of Bitcoin, Ethereum, and Litecoin. However, in this situation, based on historical returns and volatility since 2015, the portfolio which maximizes your risk-adjusted returns, I believe is 76% Bitcoin, 24% Ethereum today. And 0% Litecoin. And the reason that is because coins like Litecoin will trend up with the market and they'll do quite well. I mean, when Bitcoin does well, a lot of times Litecoin will do well. But you have to consider opportunity costs and is holding certain coins, is it worth the downside risk? Like does the potential ROI make up for the downside risk? And so you can use historical data to say, well, based on historical data, it either does compensate for it or it doesn't. For instance, we know Ethereum dropped from $1,400 down to $80. And, someone might look at that and say, well, does it make sense to have Ethereum when your downside risk is so much? And based on data, the answer would be yes. And the reason is simply because, you have to look at the returns for Ethereum. I mean, it went from like $1 up to $1,400 before dropping back down to $80. And now it's past $1,400. So there are some downsides as we discussed with modern portfolio theory. I would say one of the downsides is, so the chart you see here is basing it on historical volatility and historical returns. One could easily argue that you should be using projected returns, and sometimes I will put in my own projected returns. And a lot of times that's like the secret sauce of, say, hedge funds or whoever it may be. They're putting in their projected returns, and based on the projected returns of, say, a set of different assets, they'll figure out the portfolio that maximizes their clients' risk-adjusted return. So you want to maximize the Sharpe ratio. So, if we look at this chart, you can see we have the maximum Sharpe ratio is the star on the chart, and the yellow line that runs down the top, sort of down to the midway point, is known as the efficient frontier. So the idea behind the efficient frontier is that for a given level of volatility or risk, there exists a single portfolio which maximizes your risk-adjusted returns. So for instance, if you were looking for, say, an expected return of 120%, then you would go up over here and you would find 1.2. You would scroll all the way over, and you can see that there would be portfolios that would give you an expected return, a yearly return of 120%. But that is somewhat, to some degree, that's too good to be true. We know that crypto can give you returns like 120%, but we also know that they can give you negative 80%. So one of the things you have to do is you scroll over from a 120%, you can find a dot, and each dot on this chart represents different portfolio weights. And then if you go down from that point, you can see the volatility on that portfolio could be upwards of 100%. So what that means is that the portfolio that you choose might have an expected return of 120%, plus or minus 100%, and that should be accurate to within one standard deviation. So maybe it says your expected return could be 120%, but since it's plus or minus 20% or plus or minus 100%, it could be as low as 20% or as high as 220% to within one standard deviation. And obviously, we know that there will be phases where you will not be getting 120% on your portfolio, especially if you're buying at the peak. But the idea is, on average, if you look at year over year, this is based on Bitcoin, Ethereum, and Litecoin since inception, since 2015.
To make sure that I'm understanding correctly, we're looking at this Bitcoin, ETH, and Litecoin, and it's showing this maximum Sharpe ratio with that little star that you were just talking about. So this is actually a basket as if you would have invested in a basket of different levels of Bitcoin, ETH, and Litecoin. And then this chart is showing like that maximum Sharpe ratio is the highest risk
adjusted return.
Yes. Okay. So great.
Yeah.
Great. And then, but as we move up, just to make sure I'm understanding, as we move up this line, we're increasing the expected return as we're moving up on the y-axis, but that comes with risk as well. So meaning that you're going to probably need to have to be able to handle extreme volatility in your portfolio if you're willing to make that.
Right. And that's what a lot of people in crypto, I think, fail to take into consideration. They think, why ever buy Bitcoin when, these altcoins could theoretically give you higher returns. And the reason is because it protects you from the downside risk, right? So having Bitcoin protects you from the downside risk. And by the way, so what you're looking at here is 100,000 simulations. So you can sort of brute force it, Monte Carlo style, and just figure out which one gives you the best risk-adjusted returns. You can also use quadratic programming to just solve for it. So, the downside of just doing Monte Carlo is you always wonder, well, if I ran another 100,000 simulations, would I have found another portfolio that would have been better? Or you can just use quadratic programming and solve for it. So in this instance, if we look at say the efficient frontier, it's essentially that line that runs from the top all the way down to that middle point before it starts bending over on the downslope. So for instance, the reason why this is important is, imagine you wanted a portfolio that should yield you 110%. And you pick a portfolio, you want it to be on the efficient frontier, because if it's not, let's say it's on the bottom, like the bottom of the chart, then you're basically taking on the same level of volatility or risk, but you're getting a lower expected return, right? So you might be getting, say, you're only expecting 70% as opposed to 110%, despite the fact that you're paying for it with the same units of risk. So the idea is to maximize your expected return for every unit of risk you take on. So in this situation, I talk about the Sharpe ratio, and it's basically just it's your return minus minus the risk. It's the risk minus the risk free rate. So basically, like treasury yields, like what could you easily get in the market somewhere else, divided by the standard deviation of the portfolio's excess return.
Hey, if you like this clip, be sure to like and subscribe for more crypto related content. Also, be sure to check out the full interview and more only on realvision.com/crypto.